Hello everybody and welcome to our discussion today on credit spreads, selecting the optimal strike. This is one of many different events that are offered and sponsored by the Cusick Group, and my name is Joe Cusick. I am part of the Cusick Group, and I want to welcome everybody for being on today's presentation. Now, before we get started, I do want to take an opportunity to read through our disclosure statement. Securities and investment advisory service offered through AOS, which does business as Trading Block and Money Block, a registered broker-dealer, FINRA, NFA, a CIMIC member, and a registered investment advisor. Now, options do involve risks and may not be suitable for all investors. Take the opportunity to read the characteristics and risks of standardized options. That's available at the optionsclearingcorp.com website, or at the bottom of our pages at Money Block. You can get that blue hyperlink and click on it, and you can get the risk disclosure also for spreads, as well as the characteristics and risks of standardized options. Now, any stock option or future symbol that's displayed are for illustrative purposes only and are not intended to portray a recommendation to buy, sell, or hold any security. Now, AOS does not, nor does the Cusick Group, provide any tax or legal advice, and the content and tools are provided for educational and informational purposes only. Products and services are intended for U.S. customers and may not be available or offered in other jurisdictions. Now, today's agenda is pretty straightforward. We want to cover two strategy types, ones that I think are becoming more and more prominent and prevalent, not only for individual retail traders, but also being utilized extensively by institutional and investment advisors as well. And that is specifically, we're going to talk about the bear call spread and the bull put spread. Now, for those of you that are new, no worries. We're going to go over the mechanics of this. We'll make sure that you have a firm foundation as we get into the risk reward characteristics, as well as the looking at the optimization of strike selection based on environment. Now, we're going to jump in first into the bear call spread. Now, what we're going to do in this section is we're going to cover the bear call spread components, the market sentiment and underlying sentiment. We're going to also talk about calculating estimated move analysis of the overall underlying. And we're going to take into account volatility analysis. I think this is going to be very important. For a lot of you, this might be new. That's okay. We're recording today's event. You're going to be able to go back and watch this. We're also going to take a look at the profit and loss, as well as probability assessments, and then we'll review the selection process so that you're really firm on what we're trying to achieve. Now, a bear call spread is defined as a spread that you're going to employ when your analysis indicates that the underlying is likely to remain neutral or perhaps drop in price. Really what it means is that the strike price of the call option that you're selling, in this case the $31 call, you don't think it's going to go above there at expiration. Now, your maximum profit potential, it's defined from the moment that you actually establish the trade. In other words, it's defined and limited to the amount of credit that you receive for selling this strategy. Now, I say strategy because it's not just one leg, it's multiple legs, which means that I'm also buying another option. And in this case, I'm buying an option that has a higher strike price than what I'm selling. The reason why I'm buying that option is that I don't want to have that unlimited risk to the upside. Because when I sell a call, the risk is that the stock goes above the strike price I sell. So to limit that risk, I buy an option that has a strike price above it. In this case, I'm selling the 31s, I'm buying the 34s. If stock gets above $34, that caps off my risk to the upside. So my risk is the difference between these two strike prices minus the credit I receive. Okay? That is what the risk of the strategy is. Now, before I get into talking more and more about the mechanics, the profit and loss characteristics, strike price selection, we just got to take a step back here and really just start looking at how do you determine whether or not the credit spread, and specifically the bear call spread, is the appropriate strategy to employ or deploy. And the biggest thing I can say is that you have to have an outlook or a perspective, an opinion on the overall market. And that will be utilizing one of the many benchmarks. And what I mean by benchmark is something like an index like the S&P 500, the NASDAQ, the Russell 2000. These are the most prominent large cap as well as small cap um, indices that track those types of stocks, whether they're large cap or small caps. Now you can also get into different sector type of indices that will narrow down. In other words, you could use one for commodities, you could use one for bonds, you could use one for emerging markets, or specifically for specific countries like China. Either way, if you're looking to invest in either that overall large cap space or in a specific sector, take a look at those larger indexed products that will give you some perspective. What do I mean? For example, right now I'm looking at the XLY, which is the sector ETF that follows consumer discretionary spending or consumer discretionary stocks. And so you can see right here that I have just a few lines, basically just connecting a couple lines here. And you're looking at support and resistance. And basically the 52-week range is between 69 and 81. Now when you see that on a quotes page where you see that the 52-week range is $69 to 81, it's sometimes hard to get context. When you look at it visually, wow, I see a pretty large range. For me as a trader, I'm looking at where support and resistance is, or in other words, if I'm specifically getting remotely bearish, in this case on the market, I'm looking at where is an area where I see that there's firm resistance. In other words, the market has tested but has pulled back on this underlying. And I can clearly see that it's up in that $81 range. But I can also see as of late that I have it at 78. I also have some at 76, and I could have something here at 74. And the market's been pulling down in XLY specifically. It tried to bounce and is now in this consolidation. I think I might become a little bit bearish. Now, I'm not going to trade XLY, which you could if you so choose. And as you can see, it's pretty straightforward. XLY is an optionable sector ETF. But a lot of people ask me, well, what about choosing individual stocks? If I'm hip on that sector, I've done a lot of research, I start to understand the consumer discretionary. What stocks are in consumer discretionary? Well, if you type in XLY and in a Google search and say list holdings, you'll get a list something like this. And in this case, I'm looking at the top 10 holdings for XLY, and those are the top 10 stocks, which basically represents about 48% of that ETF. And I'm highlighting one of them, Home Depot. And I said, you know what, I like Home Depot. And the reason why I like it right now is just because I do a lot of shopping there. I love going to either rentals or I have to buy some products like, you know, whatever it is. I've gotten to know the company. I like it. I trust it. I've gone in there as a consumer and spent probably far too much money. At least that's what I've been told. But anyways, I'm looking at it going, you know what? I haven't been there in a while, though. I haven't seen a lot of sales. The last time I was there, I actually had a negative experience with one of the associates. Now, again, I'm not knocking a Home Depot, and nor have I had that experience, but let's just say hypothetically that was the case. So then what I would do is that I would take a step back and I go, well, am I really bullish on Home Depot, or am I starting to get bearish? Because I'm looking at the XLY and it's consolidating after a pullback. So either one of two things is going to happen. It could bounce and start to break to the upside, or it could continue that downside risk and downside play. And so I'm looking at the stock right now, and I saw that the stock over the last basically, let's see, I'm looking at the last year, and these are just some Fibonacci numbers. I just took peak to trough. And basically, I'm seeing where it bottomed last time, which was right down here around 107, and it's scaling up. And you see that it got up to about 135 and then started to pull back. As a matter of fact, it's retraced and got down to about 61% on the pullback of its uptick. And I'm looking at this and I'm going, okay, well, it's now hitting resistance at that 125 level, which was once a level where you saw it was 38% retracement from down here, from its low to its high in the last 52 weeks. So this could be an area where I'm going to see some potential resistance. If it breaks through 125, we could see a retest or a challenge of 135. Now again, I am not a certified technician by any means, but I'm just looking at a picture drawing some lines, basic support and resistance lines, in this case using the Fibonacci's. It does use some sequencing math, but the point being is that now I have a perspective where I see a stock that has pulled back pretty dramatically. In other words, it's basically almost retraced 2/3 of its rally, and it's now bounced off of that, but it's consolidating here right at that 121 level. I might be getting a little bearish. Now, the volume hasn't been a ton, so I don't have a ton of conviction as far as my bearishness. So that means I'm mildly bearish. So what do I do? Well, you can turn and look at a seasonality chart. I think this is a very powerful analysis tool only because it allows you to look at what has happened in the past, and specifically since 1991. You'll see that there's a correlation line that's been drawn here. This is provided by partners of Trading Block and Money Block from Tradespoon, and this is a tool that we will quite often utilize in our analysis here at the Cusick Group, where you're looking at the annual seasonal cycle. And there's a couple other features here that I'll point out, but you can clearly see that in this part of the cycle, you see that the market tends to pull down and then starts to draw to the upside. Now you have support and resistance lines that are prevalent for the next 10 days, and those will reset. And then you also have some other forecast tools here. These are the 20, 30, 40, and 50-day forecasts, and you can see the accuracy of those forecasts down below. This is just a nice tool that gives you some transparency as well as a little bit more insight utilizing some technical analysis on what is in the forecast, what are they seeing as potentially happen, and what has historically happened, and how correlated is that to the general market. And I think this is interesting, and I think right now one of the things that I'm noticing is that there is the potential for the market to break to the upside, but we're seeing resistance right now for the next 10 days at 127.25. And with the market at 121 and getting over that level of 125, I think there's some challenges. It's been consolidating. I'm thinking I'm bearish, but I'm not super bearish, meaning that I'm not willing to go out and, let's say, for example, short the stock outright, or go in and buy some puts, naked puts. So what do? Well, let's see what the market, and specifically the options marketplace, is telling me. And what I mean by that is that we're looking at an options chain that's provided by Money Block and Trading Block. Really what I'm trying to break down here is that the options marketplace is giving me an anticipation or expectation of a potential move in the underlying. How can I assess that, or how am I picking that up? Well, there's just this neat little formula that basically you're taking the front month straddle and the front month strangle. And all the front month straddle is if you're looking at the stock price, in this case 121.26, you look at the month that you're considering trading, in this case February, and you look at the closest strike price to where the stock is trading. That's the straddle. And then the strangle is the first strike out put and the first strike out call. And what I do is I take the offers, quite simply, add them up, okay, and that gives me this total of 1062. And what's interesting about this is that I divide that by 2 because I'm utilizing 2 strategies, and you'll clearly see in the next slide, and I'm just going to go back, you'll clearly see that then it gives me that with the 50% probability that the market could move either up or down between now and February expiration, $5.32. This is extremely powerful in the sense that if the stock is trading at 121 right now, I anticipate a range between now and February expiration of between 126 and some change and as low as 114 and some change. And so you're really getting some perspective here. So if I'm looking to sell maybe the 120 calls or the 125 calls, I know that selling the 125 calls in this case, I could be tested. And buying the 115 puts, well, while there is the potential for it to potentially touch that level, that's a low probability trade, and we'll get into that in just a little bit. Now, If you want to really drill it down, though, if you really want to look at specific time frames, like I want to know how much they're pricing in for the movement today. I want to know how much they're pricing it for 7 days and 30 days. You could use this quick formula. And really what this formula utilizes is the expected move over these specific time frames, utilizing the current price of the stock, the current implied volatility, which I pulled off the money block volatility page. You can see this table right here. It gives me the current implied volatility. And all I do is plug it into this formula. I take the stock price, multiply it times the current implied volatility, and divide it by the square root of specific time frames. In other words, the square root of 252 is 15.87. Why 252? Because that's how many trading days there are in a year, typically. Now leap years, there's 256, I believe. But the point being is that then I'm getting a one-day forecast of potentially moving or estimated move of about 173. Now, that is basically giving you a one standard deviation move for that specific time frame. In other words, 68% of the price action is being accounted for in the options pricing as far as what they're anticipating a potential movement in the underlying being. Now the 7-day forecast is 382, and you might wonder why. How did I get 721? Well, that's the square root of, and how many weeks are in a year? 52. And then 30-day move, which is 796. And how did I get 346 in the denominator? Well, there's 12 months in a year. There's 30 days in a month. So the square root of 12 is 346. And so basically you're seeing that over the next 30 days with basically, and it is taking into consideration about the one standard deviation move to the upside or downside, that this could potentially stay in a range of being up 796 or down 796 over the next 30 days. This is incredibly powerful for helping me now start to think about strike selection, strategy selection, and so forth. Now, I want to highlight one thing though. This is a dynamic calculation, meaning that this will change with either changes in stock price, implied volatility, days to expiration, and so forth. Someone might ask, what is the Z-score? I have a lot of people that have always asked this, and this is basically telling you the standard deviation of the current implied volatility from its mean or average. Right now, the current implied volatility is at 22. The average is 17. It's giving you a positive Z-score of 1.52, which is 1.5 standard deviations away from its average. If it was negative, that means it's below, or in other words, volatility is lower than its average over the last 52 weeks. Now you might say, well, how do I assess whether or not it's high, moderate, or low? Well, you can take a look at it visually, and you'll see that this green line is implied volatility. You can see when the green line spiked here, that's high. When it's down below here, it's low. And right here in the black, that's about moderate. This really does help me ascertain which strategy I'm going to utilize. When volatility is down here, I'm typically not going to be doing a lot of option selling strategies. The reason why is that I'm not really getting paid a ton of premium to sell an option, and more importantly, it's really not going to deliver what my impact is, which is eventually it will have to pull back. And there's really, on the lows, there's really not a lot of volatility crush opportunity. Now up here, yeah, I may want to deploy option selling strategies. And you can see right now, currently, it's above that moderate and above the lows. So you're actually seeing that implied volatility is on the move to the upside. Now, I will say that when you see volatility either at either extreme, either highs or lows, take a look at why. In other words, go do a little more research, and typically you'll find out that there's some sort of event or current environment that has been established. For example, on high volatility moments, usually you're seeing something like earnings or a geopolitical event. If you see low implied volatility, that means that there's just been some sustained trend, either or both in the overall market or in this specific underlying. So, now that we've done all of this legwork, we've done some technical analysis, we've utilized volatility to not only help us understand how much the options market is pricing in for potential movement in the underlying, it also tells us that if there's a heightened sense of maybe some big violent moves, it gives me the ability to go see what fundamentally is out there. Again, just another little flag for you. And once I've done all that work and I've established that I think that the stock is looking like it's not really going to challenge the upside, that I'm feeling that the overall market, and specifically a benchmark like the consumer discretionary sector, it's been consolidating and it may look like it's going to be pulling back. I've seen also from my seasonality chart that I see a forecast for the next 10, 20, 30, and 40 days that there looks to be some downside potential with an accuracy above 80, 85%. And then I went in and I said, you know what? Okay, volatility is a little bit higher. I didn't see anything off the bat as far as, earnings or anything of that nature, but I am aware that I have to stay on top of that. And so I looked at it and I said, you know what? The best strategy that I can deploy right now with all the components that I've checked off is that I'm going to look at doing the bear call spread. And with my forecast, the stock could potentially go down by 3.4% by expiration. Now, how did I come up with that number? That was completely subjective. Now, you could utilize something like Fibonacci's or something of that nature technically, or, whatnot. But I've looked at it and basically said, you know what, with the market at 121, the probability, the estimated move right now being priced in is right around $7. And I'm looking at that saying, you know what, the probability of it moving up $7 or down $7 isn't very high because it's been consolidating. But ball is on the move, so there is some heightened expectation. I'm going to look at selling the 125 calls, and because I am not looking for a strategy that has unlimited risk, I'm going to define that risk. If I'm going to sell that call, I'm going to buy the 130. And for this spread, I'm going to receive $1.55 or $155 per contract. Now, when you look at the risk reward, you're clearly seeing that my reward is completely defined. I know how much I'm making right off the bat. That to some people is affirming. You're like, okay, I know what I'm making and I'm comfortable with that. I could make $155. I also know what my risk is $345. And if the market does start to work against me, in other words, start going up from 121 and change, if it gets up to 126.55, I know that, okay, worst case scenario at expiration, I'm going to be break even. Okay? And you can also see that if all of a sudden there's a move, before expiration, in other words, the stock goes down a couple bucks, you can see that I could actually take off this strategy for a potential profit even before expiration. And that's something that I do want to talk about, because I do believe that when you do credit strategies, there are optimal points in time to take those credit strategies off. And I have two theories. I wouldn't say it's theories. I have two opinions on it. One is if the stock makes a fast move, in this case to the downside. In other words, in the first 5 to 10 days, in other words, let's say that the stock goes down from 121 to 117 and you're up about 25%. In other words, if you sold that strategy for $1.55, you basically see that it's now trading right around $1 and some change. I might cover that strategy. I'm not going to look a gift horse in the mouth, but I always have a resting order out there to cover the particular strategy that, in this case, if I sell it for $1.55, I'm going to buy this back for around between 75 and 80 cents. And typically I'll get to about that 50% mark of the total credit received and pull it in. I've just found that historically that has been an optimal strategy, especially when you're deploying credit spread strategies. That has been an optimal way to utilize and manage that risk and manage the profits. And I also look at this and say, you know what are the probabilities of being above and below certain levels? And you can see these are extremes. These are basically above or below 1 standard deviation moves in the underlying. And the probability of it touching. That's an important point that I want to touch on before I get into any trade is that I'll look at, okay, is there going to be a point in time where I'm going to be either able to take a profit early, or that I'm going to be sweating it out and maybe seeing a loss. And this gives me a probability of being tested that way. And you can see that there's an 89% probability of touching 120 between now and expiration. And there's a 77.5% probability of touching 125. So I know that I have a pretty decent opportunity to potentially take a profit before expiration. And I also know that I could have a decent probability of being potentially tested before expiration. So let's just surmise all of this. We basically looked for an opportunity that had a defined reward as well as a risk that fit my tolerance, my objectives, right? I'm looking to put risk capital to work and have a high probability of potential profitability. One other note that I want to make is what's a determinant or a determining point of whether or not this is an optimal strike selection and strategy. If you have a 65% probability of, with utilizing these credit spreads, of a potential profit, that's a pretty decent probability of potential success utilizing these types of strategies. And that gets down to, looking at the proximity of the stock to the strike price you're selecting. As you get a strike price that's closer to where the stock is trading, you're going to see that your probability of potential success goes down, even though that your profit potential increases because you're taking in a larger credit. Your probability of potential success is going down. So there is a trade-off in that from that respect as well. And you also see that there are other examples, but these examples are bearish examples based on sentiment and implied volatility. And one thing that I want you to recognize is that in this case I have volatility that's high, and I wanted to sell calls, right? But I wanted to do it with a defined risk, so I'm selling basically and right out of the money call spread. Something that if you're going to really push me and you want to say, well, okay, Joe, give me something that's a little bit more definitive than an out of the money call. I'm typically looking at selling calls that have a delta of 30 or less. And 30 to me with credit strategies, just for those of you that are looking for other nuggets or tidbits of information that help you with strike selection, is going to be probably the most aggressive I would get as far as the delta of the option that I would be selling. Okay? All right, now let's switch gears and take a look at a credit strategy that actually will be deployed if you're bullish or neutral to relatively bullish, okay? But you're definitely not bearish. And that's called a bull put spread. And we're going to go over the definition of it. Again, follow the market sentiment and so forth and underlying sentiment. Estimated move analysis, volatility analysis, the P&L and probability analysis, and then review the selection considerations. And I just want to make it abundantly clear, you're going to see that this is a repeatable process. Yes, you might say, well, just move on. Let's get through this stuff. If, in fact, you're starting to tackle different approaches and different strategies, and it's not something that you find that's easy and repeatable, then it's probably not going to work. Or it's definitely not going to work for you. And I really want to have very defined steps. Some people call it a trade plan. I just call it something that if you do it one or two times, it becomes a process. And, you have to be the right person to be able to trade options in a self-directed manner. But then more importantly, you have to have the right process. Once you have those two things aligned, then you will be able to choose from a variety of different products that will fit those other two components. Now, what is a bull put spread? A bull put spread is defined where you have a neutral to slightly bullish stance, and what you're going to do is you're going to sell a put with a strike price that is higher than the put that you're buying. The market outlook, again, is neutral to slightly bullish. Not very bullish, because there could be more optimal strategies to pull your risk capital than doing a bull put spread. Your risk, it's limited, but also your reward. Folks, there's always going to be trade-offs. The bottom line with this strategy is a lot like with the bear call spread. You have a conviction, a thesis that this stock is not going to go below the put of the option that you are selling. Again, where do you start? Take a look at the overall marketplace. In this case, I'm looking at the Qs, which is the ETF that tracks the NASDAQ. And you can see I'm just defining some ranges, right? I'm looking at basically around 113, 113 and some change, and I'm looking at 100. So I have support and resistance, and you can even start layering in some moving averages to kind of get an idea of what is going on with the market. In this case, the market topped out, pulled back, and is testing support. It tested it, bounced, tested it. Now, we've seen this happen in the past, and it doesn't mean it has to reproduce this past history, but let's just say that we look at the overall marketplace as now basically a level where we see support. Now, what stocks do you look at if you're following the cues, you've been monitoring the benchmark, you got a firm belief that you believe that the stock could stay in a neutral or even get into a slightly bullish trend. And you want to find stocks that are going to move like a major benchmark. Well, look at the stocks that actually make up the benchmark. Again, you can go out and Google the top stocks in the QQQ, and it will give you a list of the stocks that are in there, as well as the percent that those assets make up in that particular ETF. And you have Apple, Microsoft, Amazon. As a matter of fact, these 10 holdings are 48% of the QQQs, right? And you'll see the different asset weightings right here. So, for example, Microsoft is 8.3% of the Qs. So if you see Apple and Microsoft moving to the upside, that's a positive for the Qs, because you're looking at basically 19.5%, almost 19.5% of that index's components are moving to the upside. That's very powerful stuff once you start to understand it. So let's say that I want to look at Microsoft, and how has Microsoft been actually performing? And as a matter of fact, when you look at this, you see that Microsoft has pulled back a lot like the Qs. And now it's testing this low that it saw earlier the year previous in 2015 in late August. You know, you had the beloved dip down there. We all remember that. That was a big vol spike, and then it bounced right back. But the point being is it's retesting that 93 area, which we would call basically its support at this juncture. You can also see that the next resistance levels between 93 won't start to kick in until right around that 109 level. Almost the 110 level. That's the 38% retracement. And again, we're doing peak to trough. So you're seeing that we're going to see resistance at 110, we'll see 113 and 120. But there's a big amount of space that this thing, if in fact firms up, and it looks like it's holding here, we may want to watch it a couple more days, but if it holds here in that 93 level, we could see another potential move to the upside, or at least start to see a consolidation here. Now again, we can go in and look at the seasonality chart, and we can see that the range is pretty tight between 91 and 99. We see that the 20, 30, 40, and 50-day forecast is mixed at best, where we see lower, higher, lower, higher. So we're anticipating that this is probably going to stay in a range, and we've seen that it's been trading like that, and historically we see that it's basically stayed in a range. So let's say that we think that it's neutral more than bearish or slightly bullish. What's the option marketplace telling us, though, as far as expected move? Again, straddle strangle market divided by 2, and it's telling me that it's with a 50% probability between now and expiration, which is in March in this case, there's the potential to move up or down $7, and that is with a 50% probability. Now, if I again want to narrow it down under specific time frames, 1, 7, and 30-day, use that formula I discussed, and basically you can go in and you could see that it's pricing in the potential to move, 1 and some change, 3 and some change, and 7 and some change. And this is a dynamic calculation, so don't forget that. And as you can see, I can go through this a little bit faster, only because we're starting to just get this process down. Assess implied volatility, right? Where has it been in the past? Where is it today? And you can see that it's been actually on the move, but it's more in that moderate level. This is maybe where if I saw that it was in the moderate level, I might leave this alone. When implied volatility is kind of middle of the road, it's very difficult to find a strategy that you want to deploy, either buying or selling options. If you're already positioned, then you're just basically going to maintain your position. But if you haven't deployed a position, this is where you might want to just take a step back and say, let's wait until either I see a defined lower volatility, and that will help me understand strategically whether to deploy, or higher. In this case, because it is coming off of those lows and it has spiked up a little bit here, I'm going to actually take an opportunity to look at maybe saying, you know what, it's going to stay neutral. So I'm going to sell a spread, and specifically I'm looking at Apple. I know that I had said Microsoft before, but I'm going to look at Apple, and current stock price is at 93. I anticipate that Apple might be up around 2.4%. Again, just a subjective thing, just threw it up against the wall. But this isn't subjective. I'm looking at selling the $87.50 put spread, and I'm looking to do it for 75 cents. Now, the price that I'm selling this at is not subjective by any means. As a matter of fact, you can see the change down here. The market was 74 cents at 79. I'm choosing 75 cents because basically when I do a credit strategy, I want to receive at least a third of the width of the spread. Why is that? Why a third, Joe? Well, because basically what that's doing is that it's stopping me from selling options that might be too close to where the stock is trading, or in other words, too close to being at the money. And when the stock at $93.89, almost $94, these $90 puts are $3.89 out of the money. As a matter of fact, that's about one standard deviation out of the money. And so this is telling me that I have probably right around a 75% probability that the 90 puts are going to go out worthless. Now, because I'm buying these $87.50 puts, that defines my risk. That also moves my probabilities of success because I'm not taking in as big of a credit. So my break-even point now just moved up, and I'll show you in a minute. But that basically is moving that probability now analysis into more of a range of around 65%. So you can see that I'm risking $178 to make 72. So my max profit, well, I know I said 75, I excused the error, but it should be 72 and 178. But the point being is that I have defined risk, so that does fit what my risk profile is, what my objective is, and that's very important, not just with trading options, folks, but you need to have that risk profile nailed down as you as an investor as well. And as a matter of fact, if you have any interest, I can actually sit down with you and in probably less than 10 to 15 minutes, and as a matter of fact, I can just send you a link and you can go through a process that takes less than 5 minutes, and you can have a risk profile all done so you can understand who you are as an investor and as a trader. Now, getting back to the example, you can see the max profit you can make is 175, and the max risk you have is $1.75. The probability that it's going to get down in these levels where you're going to be tested as well as being below or above. In this case, the probability of it being above 92.5 is around 54% at expiration, and it's the being below 90 at expiration or at 90 is around 36%, but you're going to be tested. There's a 69% probability that you're going to test that $90 level, and it's currently trading at 93.84 or something like that. And you're also seeing that there's an 88% probability that you're going to be tested at the 92.5 level. So the bottom line is that knowing this information, knowing that you're going to be tested, and you see that the market pulls back one day, you're not going to be in panic mode like most traders are that don't do this as part of the exercise when they're deploying a strategy. You're going to say, yeah, I anticipated it. And the biggest thing that I did, because I saw that there was a high probability that I could potentially come down and start testing where I would lose money, I sized appropriately. I sized it appropriately. So where I was traditionally doing 5 lots or 10 lots, I'll only do 1 or 3 contracts this time. And That's very powerful stuff because that will stop you from making the biggest mistake that I've seen most traders, including myself, have done in the past, which is they trade too large. They trade way too large, and that's why you take some big hits. So again, just looking at the analyzing the analysis from this, you know, selection criteria, we were neutral to slightly bullish. In this case, we were more neutral. We saw that implied volatility was off the lows. It was neutral to looking like it was moving to the upside, and I didn't see any binary event like earnings at the time. So I'm looking at this going, you know what? Oh, it's on the move. It's well off the lows, the 52-week lows, and well off the 3-month lows. And so I'm looking at this saying, well, I'm going to sell an out-of-the-money put spread. I'm defining my risk then. I'm taking in at least a third of the width of the spread, which means that I'm most likely selling an option that has probably less than a 25% probability of being in the money at expiration. And I'm doing this also at probably because of the fact that we're trading on the lows, and if it does break the 93 level, we could see a high probability, somewhere between 70 and 80% of testing 92.5 and then 90. That I'm going to also ratchet down my size, and I'm going to do 1 to 3 contracts versus my typical size, which might be 5 to 7. And if you take that stance, you're going to find that the benefits of how you walk through that logic chain are going to improve your trading mentality. It's going to allow you to sleep at night. And more importantly, what we want to do is move that success needle a little bit further on the profitability scale. So I hope that this has been very informative. I hope you've enjoyed it. And also, if you'd like to take advantage of the additional benefits and services that I can offer you, like talking to me directly via email or phone, I am a licensed brokerage professional as well as an investment advisor. Also, if you'd like a free portfolio review or a free portfolio risk analysis that's designed to help you understand your acceptable levels of risk and reward, give me a phone call or an email. Shoot me an email at jcusick@moneyblock.com. That's jcusick@moneyblock.com. jcusick@moneyblock.com. All right, folks, I want to thank everybody for being on today, and I want to wish everybody a great rest of the trading day. Take care.